Lewis is next. Now, this is a credit retailer. Lewis Stores, Best Electric and My Home brands. It's been in the ringer recently because of problems associated with its credit model and its insurance products. Market cap has declined to 4.7 billion rand. Price earnings ratio 5.81. Dividend yield historic 10.68. So let's put up the share chart while we talk about this one. Syd, in summary, in a difficult spot. The sector has been a little bit chopped up. Ellerines has gone by the wayside. Its assets have been distributed. JD Group's been taken into Steinhoff. Well, how does Lewis look for you? I mean, that's a nasty fall you can see to the right there.
It's a nasty fall, but a lot of it, of course, has to do with the publicity surrounding the charges.
Yeah.
Now, publicity or not, I've always argued over the years that this legislation has been spoken about for 30 years and nothing's ever happened.
Yep.
It looks like after 30 odd years, it is going to happen, or it's about to happen, which means that the charge rates are going to be legislated for the first time, and Lewis, by their own admission, will suffer a reduction in earning streams from the insurance, excuse me, and all the other add-ons.
Yep.
Secondly, I must be honest, I thought the trading update through December, bearing in mind that they had Ellerines, they had Bears in there for the entire period.
62 stores.
Exactly.
Yeah. Looked a bit soft. Looked a bit weak.
I thought
disappointing.
I thought it was really disappointing. I must be honest.
Yeah, because and also competitors falling by the wayside, you'd think could be of some opportunity.
We had a competitor of 1,000 odd stores disappearing.
Yeah.
We picked up 60 odd really good stores in a different market segment, and the numbers are kind of telling me that they just didn't pick up the business.
So right now, at that price, 46 or wherever it is, having been so much higher, you thinking it's an opportunity, or are you going to stay away from this one for now?
I think there's still so much uncertainty, and of course with the prospect of rising interest rates and further retrenchments in the industry and what have you, it doesn't look good. Plus there's been very few people have spoken about this, but there's been a major change in the way furniture is sold. Obviously, in anticipation of these moves to freeze charge-out rates, the market is moving to a lay-by system. It was started off by a privately owned company. Better not mention the name, but this particular gentleman has built up a rumored to be reportedly 1.5 billion rand a year business doing lay-bys. JD Group, now it's privately owned, has moved into the same space. And essentially, if you look at that lay-by model, as long as you're not prepared to take ownership of the goods for a year, but pay for something that you don't have physical possession of, you can halve the ultimate purchase price of the goods. Lewis are not into that model because it doesn't suit them. If that takes off, and I understand that's happening at JD,
it's going to be a problem for them.
Then it's a problem. So I'm not hot at this stage.
Not hot on Lewis. Okay.